Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. All right, this was a momentous week. A lot happened. I know this video is going to run a little long. So, just to tell you up front, I'm just going to break this down. I'm going to do a lot of context setting up front. Maybe that's the main thing you're interested in. And then I have a lot of individual stocks I want to get through. There's a lot of important technical and actually fundamental developments that have happened with individual names. We had a lot of earnings and so on. All right. And just as a reminder, please like and share this content so the algorithms know what's up. You should subscribe if you want to get notified of future content. And of course, you could check out more details on my blog at drduru.com/122. All right, let's dive into it. Um, Note for a quick context, I did post a short yesterday. Today is August 1st, and yesterday, July 31st. I posted a short warning about finally a truly bearish development happening. So this is what I'm going to cover in the context setting once I get to the charts. Okay, so the two big news items for today, we had a jobs report. It was weak, but even worse, and I think more significant, was that the Bureau of Labor um, actually revised significantly downward the jobs numbers from what was it, May and June. And so July was weak, and May and June, I think, were revised all the way down to zero, essentially zero job growth. So that means the entire economic narrative that's been told about the economy being resilient and the economy hanging in there may be completely at risk. And of course, the GDP numbers also are a little weak, being distorted a lot by the whole the front running of tariffs that happened that boosted GDP in the Q1 and then, sorry, tanked GDP in Q1 and then boosted GDP in Q2. But net net, I believe I heard, and don't quote me on this, that overall growth is about 1%. So, with that context, it's important to note. So, the economy is actually weaker than we thought, and yet the stock market is at all-time highs. Yes, the stock market is not the economy. The stock market is only a small sliver of companies in the economy, but it's still quite a dichotomy. And now the market breadth divergence that I've been talking about makes so much more sense. Okay, so that's the jobs report side. And then on the economic policy side, we had tariffs that basically there were some really significant tariffs that were laid out. Today, August 1st, was another one of those deadlines. I won't go into all the numbers, of course, you can find that out, but we had some pretty heavy tariffs slapped onto our allies and trade partners. For instance, Canada's tariff, I think, goes up to now 35%. And this is in the context of when the market thought that the tariff deals were just rolling in and were not all that big newsworthy. So I think the market today, in its dip, just got overwhelmed with just too much news. And then interwoven in all of this, we still have, you can see the headline here, we still have the lingering trickling out of headlines about a deal with China. We had a framework and now we have the makings of a deal. And of course, China is extremely important to the stock market given the amount of economic activity that happens between the US and China and the rest of the world, frankly. And then we had also the president firing the BLS commissioner. This is the woman who is in charge of the statistics that go out. So imagine, you have to go to your boss, essentially your boss, and say, "Hey, sorry, we had to do a significant revision of past numbers. Okay, you're fired." That's essentially what happened. Now, there's going to be a lot of, I mean, this just no matter where you stand politically, this is just not a good look. A bad jobs or economic report comes out, and then you fire the person who leads the team that produced the numbers that you don't like. Eh, maybe you can lambast them. I mean, that's what Trump likes to do and cut and curse them out and insult them. But at least I would have at least preferred to have seen an investigation, have the person explain what happened, because we know these economic numbers are always subject to revision. And so that's just something that's just part of economics and part of statistics making. Okay, enough of that soapbox. There were a lot of big tech earnings today. That was also a big news. A lot of it was very important for AI. There's another headline I wanted to point out here. Right, we had a huge IPO from Figma, ticker symbol FIG. And that was, a sign of hope that the current selling is probably going to be shallow, as I expect. And again, I'm about to get into the charts and give the case for why this is probably going to be a shallow pullback. Okay, I think that's enough for the headlines. You can, of course, come back to this is Yahoo Finance with the time stamp. All right, let's dive into the charts. So, like I said, I did produce a short earlier yesterday because what happened yesterday, Thursday, was that AT50, what I like to call AT50 for above the 50, that stands for the percentage of stocks trading above the 50-day moving averages, plunged yesterday. So it dropped basically 18 percentage points in just 4 trading days. But yesterday was the big day where it broke down. You can see I could put in just a very rough line here just to show you what I'm talking about in terms of the breakdown. Let's do a horizontal ray. And there's the approximate line that was the line in the sand for me. So that's why I published a short saying, look, market breadth is broken down. The bearish divergence is confirmed, and it's a very bearish trading signal. Now, I didn't flip bearish, and in fact, when I write my blog on this for more details, I'm going to flip from bullish to neutral. I just can't go bearish until significant technical support levels are broken. And again, I'll show you that in a second. So what happened today was sellers followed through in a big way. So now we've fallen all the way down to 43%. We haven't been this low since the middle of the rebound from the April lows. So that's why this plunge, essentially market breadth, is so important. Now let's understand some of the machinery here that goes on with market breadth. So market breadth is supposed to represent the entire stock market, all the stocks in the stock market, regardless of how big or how small they are. So when you have stocks quickly tumbling under the 50-day moving averages, it means that most of the portfolios that people have of individual stocks are showing losses because just on a numerical basis, a lot of stocks are falling below key technical supports. Market breadth also shows that a lot of key stocks are just falling, even as the big cap tech stocks that keep the indices levitating are doing okay or rallying. And of course, that even fell apart today, Friday. That's why market breadth also weighed very heavily. So this confirms the bearishness. Now, I am going to go neutral. I'm not going crazy with bearishness, but the key point here is that the machinery says individual stocks are falling. So this is not a time to be speculating and chasing momentum and meme stocks higher, which is what's been happening as people have been looking for trade ideas on cheaper stocks and not wanting to chase the stocks that are quote unquote very expensive because they have high stock prices. And now let's look at the analog or the equivalent market breadth indicator, which is the percentage of stocks trading above their 200-day moving averages, which I like to call AT200 for above the 200. And you can see how neatly it failed. And I warned about this when it happened. Look how neatly it failed at this level. This is 56%, and it failed at this level that marked the previous all-time high for the S&P 500 in February. So the long-term market breadth was already warning that the underlying market was starting to weaken, even from a longer-term perspective. And sure enough, it's dropped now about 12 percentage points in 5 trading days. And so this is yet more confirmation that the underlying technicals of the market are weak. They're not just weakening, they are weak. Okay, let me just go back to AT50 really quickly, just so I can calculate. So notice this was the one day, July 23rd. This was a week and a half ago, where the last day that AT50 was in overbought territory. It was at 70, let's just call it 75%. And now it's fallen 5 out of the last 6 days, all the way down. Sorry, 6 out of the last 7 days, all the way to 43%. So that is a whopping 32% percentage points in a very short amount of time. So this is steep, steep, steep selling. The only good thing I can say about this is that this kind of selling is almost like panic selling, right? Stocks are being dumped overboard. But I don't think the recovery from this selling is going to be that dramatic. Certainly not as dramatic as the bounce back we had from April. We really need true oversold conditions to get that kind of action going. Okay, let's take a look at the indices, the impact there. Here's the S&P 500. I'll zoom in for a second. When I posted yesterday in the short, you could see why I was alarmed is that the S&P 500 posted another bearish engulfing pattern. This previous one early in mid-month, July 15th, the market just rallied right through it and so quickly invalidated it. And what I was looking for yesterday was to say, okay, is the market going to validate this? Oh, sorry, are the buyers just going to be able to invalidate this one as well? The answer is no. S&P 500 fell 1.6% today, and you can see that it can still fall before hitting the first critical support, which is the 50-day moving average in this red line. And that would be around, let's see, what is that? That is S&P 500 at 61.29. Let's call it 61.30. So it only has to fall another 100 points, which was the amount of loss that was today to hit the 50-day moving average. And then again, as a buying opportunity, it would be great for that to happen very quickly because again, it would wash out a lot of sellers, and an S&P 500 that tests the 50-day moving average very quickly will be below the lower Bollinger Band, which is this black line. Again, the Bollinger Band describes about 80% of the trading action, or the way I set it up, about 80% of the trading action around the 20-day moving average, which is the dotted line. So if the S&P 500 were just to get this selling over with and just fall another 100 points on Monday, that would be great. And then we could get this overextension, and that would be subject to a big bounce. If we don't, and the buyers just rush in on Monday, I suspect we're just going to churn for a while because this is a pretty significant topping confirmation of a topping pattern. And it takes a while usually for this kind of stuff to heal. All right, let's take a look at the NASDAQ. Similar story here. The NASDAQ has now fallen below its 20-day moving average. I forgot to point out the S&P 500 also did the same. Notice how well the 20-day moving average is held as support for this entire rally off the April lows. I mean, this has been impressive. So as impressive as this rally has been, that means that we really need to take note when that trend line breaks, right? So it broke on the S&P 500, also broke on the NASDAQ. And again, same story here. Look at the 50-day moving average is below the lower Bollinger Band. It would be great if we could get just another 400 to 500 points down very quickly on the NASDAQ, test that 50-day moving average, and really set up a good, solid buying opportunity for at least short-term and swing trades. Now, unfortunately, given all the selling and the drop in market breadth, it means, of course, that small caps probably suffered. And sure enough, small caps suffered 2%, actually not as bad as the NASDAQ's 2.2% loss. And buyers did jump into IWM from the intraday lows, but still it fell below the 200-day moving average. So that 200-day moving average breakout is over. I hate to see that. And it's struggling now to hold the 50-day moving average as support. You can see how the 200-day moving average and 50-day moving average have converged. That was supposed to be very firm support, and now it looks like weak support. Notice how IWM is already below its lower Bollinger Band. And I went ahead and did another speculative trade, which is a calendar call spread. I think at the 220 level, the long will expire this coming Friday, and the short will expire next Friday. And by the way, as always, please, if you're going to do some trades and investments, use your own risk tolerance and time horizons, okay? I'm providing all of this information for educational purposes only. All right. So I think that the IWM is already overextended, but it should fall even further if we get, or if the market decides to take the major indices down lower into 50-day moving average support. Okay. And the other thing to remember, I'll put a link in the show notes, which is that we are entering a seasonally weak part of the stock market, August through October, and seasonally weak just means This is the period when big drawdowns tend to happen. Even if the month ends positively, big drawdowns tend to happen. I think for August, the average or the averages and median drawdowns are around maximum drawdowns, sorry, around 3% in that range. And so the S&P 500 already fell 1.6% today. So, it's not going to take much. Like I said, if we just get another swish down on Monday and test 50-day moving average, support for the S&P 500 will already be at a typical maximum drawdown for August. So that's why, again, I think that just getting the selling over with would be very good for opening up the next set of buying opportunities. And it's also why I'm definitely not going bearish. I'm just going to downshift. I'm going to just shift out of buy and going into neutral and just staying there for the time being until, some of this dust settles out. All right. Let's look at the VIX. I haven't looked at this in a while. And sorry, let me go into logarithmic style. Sorry, I didn't do logarithmic on the major indices there. You can see the VIX, of course, soared. Yesterday was the first really perk. Perking up, the VIX went up 8%. And so that was also another early warning of what was to come. And now the VIX being above 20 is in the area that's considered elevated volatility. And as you can see, given where we were back in April, the VIX could actually rally quite significantly to fill up some space here. So, if we get that big drawdown on Monday or Tuesday that I'm looking for to set up the next buying opportunity, the VIX will be well overextended. Let's say it jumps to 25, 26%. That would definitely be an overextended volatility index and an opportunity to buy, sell some puts and stuff like that. Okay, so that's what I'll be looking for. Now, that is the overall context for the market. I'm now going to jump into a series of individual charts. I mean, there's just so much going on, so much richness for anyone who likes technical analysis. Hang in there. Let's jump in. I'm going to start with the big caps. Amazon. .com, ticker symbol AMZN. I have this old trading rule, which is to buy Amazon no matter what its earnings or performance is, in the expectation that it will be higher in 2 weeks. This seemed like a great time to kick in that trading rule because Amazon broke down below 50-day moving average. I'm hoping it's overextended to the downside. It fell 8.3% post earnings, and it has 200-day moving average support right below there. So I did a calendar call spread. I think at the 220 level oh wow, that's just like my IWM calendar call spread. With the long side expiring coming Friday and the short side expiring this coming Friday, the long side expiring the following Friday. And so the idea here is that it's going to take buyers a little bit of time to get their sea legs back. And by that time, the short side should shrivel to nothing. I could take profits on that, and it basically partially pays for, or maybe pays for all of the long side of the call. So that's the idea there. You can see Amazon made a clean break of its nice uptrend on the 20-day moving average. And with a big cap tech stock like Amazon falling this much, the major indices didn't stand much of a chance. Apple also reported earnings last night. I think investors were a little confused as to how to interpret this. I listened to CNBC. There's mostly bullish interpretation. You could see Apple gapped higher after earnings. I don't know what the percent is. Let's just call that, say, about 2%. It gapped up higher, it rallied, and then sold off quickly with the market. This sell-off now creates its own bearish engulfing pattern. And on top of that, it broke down below its 50-day moving average. So I'm already short Apple. I'm short Apple for a longer time span. It was based on some earlier technicals. What happened today kind of confirms that Apple is actually in an extended weakening process. So anyway, it lost 2.5% post earnings at the end of the day. And this is a very damaging what we call gapping crap post earnings reversal. So Apple to me has been in bearish territory even with this 50-day moving average breakout back in June, and it now has reconfirmed that it's in bearish territory. All right, Meta was a big, big, big winner this week. Post earnings, this is on Thursday, it soared 11.2%, yet it could not hold back the sellers. Sellers took it down 3%. And this is the line that buyers must hold. This was the previous closing all-time high. Back when Meta dropped below this, I pointed out how this was a bad sign for Meta, but I said it was not bearish. It was just something to keep a note of that this buying momentum had come to an end. So it's taken earned look, notice how Meta drifted all the way into a test of its 50-day moving average over that time. So in a sense, it was a bearish. It did confirm the bearishness of that of this fallback from the all-time high, this gap and crap technical pattern. And so now, buyers may have overextended themselves with that 11.3% post-earnings move because going into earnings, clearly people were losing enthusiasm. So I am looking to see if Meta can hold this line. If it doesn't, I will have to say Meta is bearish, like officially bearish, if it closes below this previous all-time high. So that's what I'm looking for there. Our next big cap tech that reported earnings was Microsoft. Microsoft is very ugly. So it joined the $4 trillion club along with Nvidia. But it gapped and crapped in a major way. I mean, this is not supposed to happen. First of all, it's not supposed to go up this high. I mean, a big caps a $4 trillion stock is just not supposed to move like this. So I think at one point it was up 12% or something crazy. Not maybe not 12%, but like 8% after hours. I don't have the immediate calculation here for how far it opened up, but it gapped and crapped down to just I shouldn't say, just a 4.0% post earnings gain. And you can see sellers just continued the fade. What this is called a post earnings fade to a 1.8% loss today. So to me, Microsoft is I'm actually looking for a buy on a setup that Swing Trade Bot calls a calm after the storm. So what a calm after the storm is like there's some big action. Usually it's a big rally, and then sellers take profits, and then the selling momentum slows down, and then it bases, or you get some sort of doji, some sort of candle that signifies that the selling momentum is over. You buy it, and then hopefully you get to ride a resumption of the previous trend. So that's what I'm looking at for Microsoft. You can see like so many of the big cap techs, it had the benefit of just following right along this 20-day moving average. You could be as complacent as you want to be, just ride Microsoft higher. And my bad, totally my bad for not buying into Microsoft and putting it back onto my generative AI buy list after May earnings. Because look at this. I mean, it gapped above 200-day moving average and it just pretty much trickled higher for these last 3 months. So, it was really my bad not to already be in Microsoft. I'm not going to make that mistake again. Okay, let's round out some of the big cap techs. Google reported earnings the previous week. You can see that it also gapped and crap. This is the calm after the storm action, and the stock just kind of dribbled higher, but it never got above its post-earnings high before sellers took over again. So unfortunately, all of the post-earning gains are gone from Google. Google is still bullish just because it's above its 20-day moving average. And so I'm going to look hopefully to buy it here at this support or maybe a 50-day moving average support. Google is still on my generative AI list, but it's way down at the bottom. And then finally, of course, we can't forget about Nvidia. Nvidia is our other $4 trillion stock. You can see Nvidia also, it couldn't help but fall 2.3% today, but it is still comfortably above its 20-day moving average line. So, nothing has changed in terms of the technical picture, the overall technical trend for Nvidia. There's not even a bearish engulfing pattern for me to claim that Nvidia is topping out. So I will keep Nvidia on my short-term trading radar. Okay, that's the big cap tech picture that I want to show. I have a lot of individual stocks. Bear with me as I go through them. Some of these are stocks that I currently hold and that I've written about before, and I want to just give quick updates. So Albemarle, which is a lithium company. I posted about this because this is a stock that I bought on a 50-day moving average breakout. I was really happy to be able to ride this trend into a 200-day moving average breakout, which was bullish. And sorry, the ticker symbol here is ALB. But earnings, but it fell into earnings very orderly actually, and earnings the selling kept going. Fortunately, today it outperformed the market. It held essentially flat above the 50-day moving average support. So I'm actually looking to buy more shares if Albemarle makes its a second higher close from this point. I mean, I just love this setup still. The 50-day moving average breakout was a great setup, and now testing the 50-day moving average as support is great setup. I really don't like, though, this breakdown below the 200-day moving average because the 200 DMA is in a big downtrend, 2.5 year downtrend. And you can see how Albemarle has struggled to break out and stay above that line. So still a little wary, but I am trying to I'm trying to stick by this trade. I don't have an official stop loss point for this. It's just going to be sort of conditional on how things are going in the rest of the market. Okay, Sarepta. Let's take a look at what happened to Sarepta. I think I've talked enough about this one. I thought I would just leave this alone. I'm still not going to touch it ever again, but it's just so ironic to me that the market had it right in terms of picking this bottom. The FDA allowed them to start selling their new drug, sorry, their main drug again, and the stock immediately gapped up and gained about 14%. I think in the after hours, I think it was up as much as I heard anyway. It was up a lot more than that. So I think that buyers are also getting tired of this stock. Ticker symbols SRPT. Just a lot of risk. As I showed before, the long term is just very ugly for this stock. It's essentially a broken stock. So they have to do a lot more to prove that this is a worthwhile, more than just a speculative trade. All right, NVO. This is another, pharmaceutical company that just really was disappointing. I've posted and recorded enough on the past action, but man, did they disappoint big time after warning on earnings. It fell. I mean, I couldn't believe actually how far it fell, 22%. So there's a lot of false signal that happened going into this drop, and they changed the CEO. They got in a new CEO as well. But the biggest, so of course, the technical signals fake me out. This 50-day moving average that I bought into, sorry, 50-day moving average breakout that I bought into was very bullish, and I bought into it. I thought it was confirmed by this activist hedge fund, Parvis, that built a big stake in Novo Nordisk, ticker symbol NVO, but it's been all downhill since then. And the lesson for me is that um, if you look back at how bearish and Novartis, sorry, not Novartis, Novo Nordisk looked, it confirmed a head and shoulders breakdown. It just trended down. Just with hindsight, this news about the activist hedge fund was actually a sell the news event. Now, I couldn't know that, and I thought it was confirmation, but the lesson is that once that gain was completely erased, that should have been my big red flag just to get out, because that price action said that the market had stopped believing that that news was important. And so now, after that massive earnings warning, 22% down, the stock has just continued to sell. I think it was yesterday, maybe it was Wednesday, that Trump is threatening U.S. pharmaceutical companies. I know Novo is Dutch, I think it's European. But anyway, price controls are on their way. First, the administration is going to try to get these companies to bow down voluntarily. And if they don't, I think there will be some regulations coming. So this whole space has become uninvestable and pretty much untradeable to me, both pharmaceutical companies and health insurance companies. So I don't like to sell in a panic, and that's what's happening right now with NVO. So I am just looking for the next rebound to sell into, and I'll just have to take my loss and just move on. And as I mentioned in a post where I talked about how most individual stocks are rentals, not soulmates, this is a classic example. It's like, why stick around suffering in a stock that can't get out of its downtrend when there's so many other stocks in the stock market that are doing better and offer better prospects? NVO has proven itself to be a rental. Okay, let's do some good news. Well, actually, it was good news. Uber, I do not think of as a rental. I think of this as more of a long term. It's not a soulmate, but I do think this is long term. I am disappointed it broke down below its 50-day moving average. So technically it's bearish, but I am building a long-term position in this one. So I see no reason to buy again if it tests this support level, which held back in May and June. When I say this, I'm talking about this line here. Oops, sorry about that. Let's get this straight. This was where Uber basically made a double test back in May and June. This was at around $81.50. So I'm not going to buy more if it tests that, but I will buy more if it tests the 200-day moving average, which is around $77. Okay. All right. Let's look at Dollar General. Dollar General has been selling off all of July, and look at that. Today, it outperformed big time. It jumped 3.4%, 3.5%. I don't know what the news is, but I would look to get back into Dollar General if it could break out above this converged resistance from the 20-day moving average and 50-day moving average. This is ticker symbol DG. And notice why I'm interested in this is because it had a big earn post earnings gain back in June of 16, this is called 15.9%. While that post earnings low has given way, it looks like buyers want to defend the rest of the gains there. So that's why it looks interesting. Okay, Impinj, oh, sorry, Polaris, ticker symbol PII. This is a classic example of a stock that may be going from bullish breakout to bearish fake out. It had a nice breakout above the 200-day moving average with a 16.8% post earnings gain. And then sellers just basically took profits and now have wiped out the entire gain. And now it's resting on top of the 200-day moving average and 20-day moving average converge support. So if a calm after the storm pattern can develop, which means that buyers defend this converge support, I could consider buying this with the assumption that the uptrend, the recovery from the lows that's following this 20-day moving average is about to resume. But so this is on my watch list. But if it breaks, if it sells off further from here, I take it right off the watch list very quickly. Okay. Now, PI, ticker symbol PI, which is Impinj, is still in a very bullish position. Yesterday, it broke out 26%, 26.5% post earnings, clearly broke out above its 200-day moving average resistance, and now didn't do too badly today. It lost 1.1%. So it looks like there's still some interest there. This is a stock that's really taken me for a loop. I did not have any shares in it here. I did not want to risk the earnings result, but it is definitely building up some bullish momentum. So that's some good news there. All right, let's go to Whirlpool because I talked about the bearishness for Whirlpool. It had a post-earnings collapse of 13.4%. I took the risk of holding my put option and I actually added to it. Not because I specifically thought that earnings was going to be this bad, but just the technicals just look really poor to me. And so I was looking through the earnings event for just a resumption of some sort of selling. So this is just a fortuitous gain here. Of course, I took the profits on that day, and sellers have continued to take Whirlpool down. I think the biggest problem for Whirlpool, ticker symbol WHR, is that they're likely going to cut their dividend. And probably that dividend was one of the main reasons why the stock was ever even able to rally and create this false 200-day moving average breakout back in July. So without that dividend, it just removes one more reason for people to stick around into this stock. Okay, UPS. Oh man, talk about a stock that just cannot catch a break. United Parcel Service, ticker symbol UPS. It is trading back to pandemic lows. I mean, it's been in a steady, well, not a steady, but a very choppy downtrend since topping out in what is this, early 2022. I hate to try to catch a falling knife. I mean, clearly this has been a short for a long time, for years. But when such an important company to the economy as UPS falls to its pandemic lows, I just could not resist. And you can see, I mean, the sellers are just not letting up. UPS has closed now since falling 10.6% post earnings. Sellers have consistently taken the stock further and further down, holding it below its lower Bollinger Band. You cannot get more worse selling pressure than this. The volume is still extremely high. You can see these bars down here. This is just straight up ugliness. So every now and then I do take a little bit of a risk, and I went in and took in a position on UPS. I actually did a very bullish position, which I sold a put and used that premium to buy a call option. But I don't mind getting put the stock if the stock closes below the strike that I sold at. And sorry, I can't remember exactly where I sold it at. I think it was. I'm not going to try to guess. I think it may have been 87.50. I can't quite remember. But regardless, I'm trying to bet on some sort of stabilization and eventual rebound in coming months, maybe even years. If it falls below its post-pandemic, if UPS falls below its post-pandemic low, obviously I just need to forget about it and just assume that this is a stock that is in some kind of secular downtrend, bearish economic event, disaster, right? So there will be limits to the kind of risk and speculation that I would do here. All right, Duolingo, ticker symbol DUOL. It is now bearish. That's just plain and simple, just bearish. It long ago reversed its nice post earnings gains of 21.6% from May, and it's now below its 200-day moving average. It is just bearish. There's nothing else to say here. I'm not going to short it just because I think Duolingo is the kind of stock that could pop 5, 10% any given day, just because it's a well-known name and I think it's a well-liked app. Um, but I did want to pull this up because it's a warning, it's a reminder to traders and investors that just because a stock has a great earnings day doesn't mean that investors are going to hang on to the story. I have no idea why people have changed their opinion of the company's prospects, but this is a very bright red flag on this stock if it can't hold a 21.6% post earnings gain until the next earnings cycle, and in fact is now at a post earnings loss. So I am very interested to see what happens to Duolingo in its after its next earnings report. Okay, let's jump into eBay, which is on the other side of the ledger. It had a very good post earnings surge. I mean, this is amazing. 18.3%. It held its ground today. It closed flat. So people are still buying into the positive news. I think this is an all-time high. Yes, this is an all-time high for eBay. I never thought eBay could pull this off. I always think of eBay as such an old dot-com boom and bust company. But look, it's figuring out ways of being an investable stock. This is impressive. And look at how neatly it tested 50-day moving average support earlier. So I don't think I'm going to buy eBay. I just can't chase here, but I will check in from time to time on the stock and see if it offers any decent entries. So on the other side, we have Etsy, ticker symbol ETSY, and it fell post earnings. Let's see. The same day that eBay soared, Etsy fell 6% post earnings, but it is still hanging in there above its 50-day moving average. So I'm actually going to look for a potential, at least short-term trading opportunity here or at the 200-day moving average, so the 50-day moving average is around 57. 50-day moving average is around 57, 200-day moving average around 52. And so that is Etsy. And I've written and traded about this stock earlier. Okay, now let's talk about some consumer discretionary eateries because there's some important developments here as well. Shake Shack, very poor earnings, fell 14.6%. Sellers continued the pressure, down another 7.1%. This is ticker symbol SHAK. It is now bearish, trading below its 200-day moving average. So whenever well-loved eating, casual discretionary stocks fall out of bed, it starts to take down the sector and makes me a lot more bearish on these kinds of stocks. So for instance, I actually just closed a short in Brinker, ticker symbol EAT. This was a very small gain. I mean, I was just playing a 50-day moving average breakdown. I held as it rallied right back into that resistance. And then I just took advantage of today's small loss to get out. But you can see EAT has had a very impressive breakout and long-term, sorry, and um, what is this, a year and a half, almost 2 year uptrend. But notice how it stopped short of its all-time high made in early 2025. So that is a yellow flag warning. It doesn't become a red flag until or unless EAT falls below its 200-day moving average. But given what I'm seeing, it's possible that that could happen. Now, on the other hand, we have a stock like Wingstop, ticker symbol WING, which soared, what was this? 26.8% or 26.9% post earnings. But as big as this gain was, it only took the stock right to its previous high back in June. And it fell short, right? The buyers couldn't keep pushing the issue. So given what I think is developing in this sector, consumer discretionary in particular, and the jobs report and the economy starting to wobble, I just went ahead and did a very speculative short on Wingstop earlier in the day. So this is not a big time call, but I think it could at least retest 50-day moving average support. But if and when it does, I'm actually going to wait it out and see if the sellers continue because it's very possible that this big gain was an overreaction, just given where Wingstop is now. You can see this double top pattern here that it confirmed. And actually, let me extend out this previous support line, which was at, sorry, let me get it. There we go. So this would be the first spot that buyers will probably try to defend right above the 50-day moving average. We had this line at around, let's just call it 348. And this was previous resistance. So it should be support. It didn't hold a support too well back in June. So there's a lot that can happen, a lot of scenarios for Wingstop. All right, let's do some let's do some tech stocks. Qualcomm, bearish. It had a 7.7% post earnings drop, sliced clean through 200-day and 50-day moving averages. So it's bearish. I'm not going to short it. I might try to fade it if it runs back up to resistance, but otherwise, this is just a stock whose rally and recovery has come to an end. Ticker symbol QCOM. Here's a stock that surprised me. This is a ATI Incorporated, ticker symbol ATI. It's a specialty materials, steel. I think they do some steel, but definitely specialty materials company. It had, and unfortunately, I didn't look at the news to understand exactly why this happened. It dropped a whopping 18.4% post earnings, broke down below 50-day moving average, but ATI has been a long-term favorite stock of mine. Again, my bad that I didn't just stick with it all this time. I just traded in and out. So I went ahead and sold a put. I think I sold it at the 75 strike. Don't quote me on that. And I do not mind getting put this stock because I really should never have sold it in the first place. I like this one just in terms of as a bet on the US industrial economy. Okay, I was really proud of this one. Itron Incorporated, ticker symbol ITRI. Oh man, it was so tough to get rid of this one. It had it is another one of these stocks that I bought as a breakout above the 200-day moving average from the April recovery. It had such a fantastic uptrend, followed that 20-day moving average. So I dared to hold it through earnings and it disappointed. It dropped 10% post earnings. 50-day moving average breakdown. I sold it yesterday, just went ahead and locked in my remaining profits. I hate to let go of this one, but when a stock falls like that from its all-time high and on high volume on post earnings, it just says that the party is over and time to hit the reset button. And of course, today sellers put an exclamation point on that by extending this overextended selling pressure to a 1.1% loss and further below the lower Bollinger Band. So I'm going to keep it on my watch list. But very disappointing turn of events there. And speaking of disappointing turning events, I also had to let go. Actually, this one wasn't close locking in profits. iSurge was limiting my losses. So I was trying to hold in. Deutsche Bank slammed the stock back in June with a 440 price target. Buyers fought back valiantly, but then iSurge gapped up and then sold down and for a loss on its first day post earnings. It lost, I mean, it was only 1.8%, but that was all I needed to see. It tells me that unfortunately the tide is shifting, likely shifting on Intuitive Surgical, ticker symbol ISRG. And so I'm just gonna sit back and watch this. It needs to get back into a bullish position, which would be above the 200-day moving average for me to consider getting back in again. So that was a unfortunate turn of events. And actually, as I'm talking through this video, I'm realizing that I'm feeling less and less enthusiastic about this market overall because of these kinds of disappointments that I keep seeing over and over and over again. Okay, sorry, there's some more discretionary, consumer discretionary. Starbucks, plain and simple. It fought valiantly after earnings, but again, it gapped higher above the 200 moving average, but then gapped and crapped. It was a very small loss, but it doesn't matter what the size of the loss is on the day. It was a gap and crap, and sellers put an exclamation point on that by then taking Starbucks ticker symbol SBUX under its 50-day moving average. And then again, they've overextended the stock to the downside, well below its lower Bollinger Band. It lost another 2.6% today. So again, Starbucks is in a bearish position. I wouldn't buy it here. I would wait until it at least gets above its 50-day moving average, and I would feel much more comfortable waiting until it got above its 200-day moving average. Okay, here's a stock that reminds me why I'm getting less and less enthusiastic. This post earnings move just totally blew me out the water. This is Fluor Corporation. They're basically an infrastructure construction company. They're supposed to have some very good business with data centers and power, utilities, and so on. Ticker symbols FLR. I was riding this recovery very nicely. I think I bought more shares back in here. I've been holding on to this stock for a bit, but man, it got crushed in earnings today, 27%, well below all the support levels, wiped out my gain and then some. And so now, of course, I'm not going to sell into a panic. But now I face the prospect of deciding how much more pain do I want to hold on to when it seems like the story should be intact. But man, their earnings were so bad. They dropped guidance. Management, of course, reassured that the long-term fundamentals of the business are still strong. But yeah, they say that, but look at the stock. I mean, the stock fell short now of its previous all-time highs set way back in 2018. And in fact, actually, let me go back further. Its all-time, sorry, I shouldn't have said all-time high. Its previous high was in 2018, but its all-time high was way back in 2008. So I was thinking that this nice rebound from the pandemic, sorry, from the April lows was part of this steady recovery to eventually get back to these levels. But with an earnings drop of 27%, that just tells me that the long-term prospects, if they are good, we're talking about 5, 10 years. We're not talking about a few years. So I haven't decided when I'll get out of this one again, but this is just another one of those disappointments that's really reducing my enthusiasm for the market overall, and why I think I'm well justified in downgrading from a bullish to a neutral position. Okay, another downer was IBM. I thought I was taking advantage of a nice buying opportunity after IBM dropped 7.6% post earnings. Yes, it was in a bearish position below its 50-day moving average. But it looked like it was stabilizing in price. Let me zoom in here. You see how the buyers fought back at the intraday low on the first post earnings day and on the second post earnings day. And then IBM closed at a post earnings high on that third day. So that I thought was a good sign that IBM was at least stabilizing, but then the sellers came back and it's come down 4 straight days. It neatly tested 200-day moving average support, which is at around 246. Let's call it 246.50, and it rebounded from that. So this is the last straw. You can see how well IBM has been doing with this 200-day moving average going all the way back to the fall of 2023. So if it closes below the support, that's a very bad sign, and I'll have to consider just getting out of the trade and fighting another day and waiting for a different entry point. So anyway, that's IBM, and my main interest in IBM is just as a quote unquote cheap play on AI and cloud, sorry, not cloud, AI computing and hopefully quantum computing as well sometime in the future. Okay, let's get back to some good news. Reddit had a fantastic post-earnings day. It used, I think it's riding success with its AI driven advertising machine. They've got lots of content to deliver very targeted ads to folks. It looks like that's working out great for them. 17.4% post-earnings gain to $188.64. It looks like it's on track to regain its all-time high, which was around 227. But of course, general market weakness will slow things down and maybe even cause a little bit of reversal. But what I really like about this technical pattern is that Reddit jumped above its 200-day moving average. It pivoted around its 20-day moving average on a small pullback, and now this big post-earnings gain just reinforces the bullishness. So Reddit is a solid bullish stock. It's just not one, my method is not to chase these kinds of big gains. All right, but I like everything that's happening with Reddit. Good stuff, even though the valuation is very high. Airbnb, very simple. It is bearish, even though overall it's just kind of churning along. You could see in this long-term chart, it's just, you know, over since its IPO, it's basically just churning a whole lot. It's in a huge trading range, and that trading range has just tightened in the last 2.5 years. But it's bearish now going into earnings next week, so it's definitely a no touch. It gapped down below 200-day moving average support for a 3.3% loss. So this is not a good look. I would not be a buyer here. Okay, another stock that long term, and this is one I've written about before. I'll just quickly say that I'm so glad I went ahead and just took profits on my second trade when it stopped cold at 50-day moving average resistance. Because I could just see the tide turning. And again, I've written about this. I won't repeat it here, but the post earnings loss here of, let's say that's a post earnings loss of 6% was further confirmed by another 4% loss. And now FICO is incredibly now trading at a 52-week low. And you could see that definitely this long-term uptrend that was in place from this 2022 breakout is in trouble. I mean, the uptrend is obviously still it's over, but who knows how much of this gain is now going to be reversed as FICO. This is FICO, ticker symbol FICO, company name Fair Isaac Corporation. You should know them from credit scores. And the director of the FHFA wants to see more competition, wants to see prices coming down for that. So I think FICO has just been riding its sort of monopoly position, and that once that mode is over, all the people who love to buy into moats are just going to get out, and I think that's what's happening. And actually, sorry, let me give you a look at the 1 week. You could just see how consistent a winner FICO has been for decades. So the fun is over for now. It's not likely to completely collapse anytime soon, but I was hoping to jump on this bandwagon, and I just happened to try to get in at a time when the tide is turning. This is just another stock where it had a good time, and now the tides look to be turning. Okay, so that is FICO. All right, some good news here. My favorite AI play, Vertiv Holdings, ticker symbol VRT, had a nice earnings response. It was moderate, but it is putting me on alert because it gapped down today with the market, of course, fell 2.8%, stopped just short of its all-time high. So I'm a little wary. I never like to see a stock stop short of its all-time high after earnings and then gap down. That to me is a big yellow flag. But because Vertiv is my favorite of all the individual AI stocks that I trade or buy into, I'm just going to hold on. I have a small remaining core position, and I am looking forward to accumulating more shares, assuming no bad news comes up company specific bad news comes up. I definitely want to accumulate some more shares on a bigger pullback because I think the all-time high will be broken at some point. Who knows? It could take months, maybe it'll be next year, who knows? But I just really love this stock. Here's a stock that I almost gave up on. I've written again about this and why I was looking for an entry point. This is Fiverr International, ticker symbol FVRR. The company made a lot of headlines and stirs about replacing workers with AI and making AI a part of its contract. Sorry, they have a platform for contractors and freelancers. And I was about to give up on this stock. It dropped a whopping 11.9% post earnings. But then I saw that I think it was Goldman upgraded the stock and gave it I think it was a $30 price target, blew me away. And I went to just look at headline earnings, and sure enough, Fiverr, um, everything was in line. They reported in line to consensus. They reaffirmed their guidance. So under the surface, maybe there's something that freaked people out, but seeing the upgrade, actually, I don't think it was Goldman. Maybe it was Oppenheimer that gave it, that went from neutral to buy, and outperformed, sorry. So I think that was Oppenheimer. So that to me tells me, okay, maybe I do want to buy some more shares at the lows. So you can see Fiverr's been struggling, I mean, for a long time. And it is basically in this big trading range. It had a big bubble, of course, during the pandemic, and is trying to hold its all-time lows that were set back in 2019. I don't think it'll ever get back to its previous glory days, but at some point, I think that this extended trading range could and should break out. So we'll see. The CEO sounds to be pretty visionary, but we'll see. And, I've been burned by analysts before, of course, we all have, but it didn't feel right selling the stock here when it just got a major upgrade and a major bearish to bullish upgrade at that by a major firm. Okay, now I'm going to finish off with the speculative stuff that I've been just looking for sentiment to just track market sentiment. So like I said at the top, this market breadth breakdown in the market, all the other bad technicals, the deteriorating underlying technicals and health of the market means that this is not a time when I would be chasing momentum or chasing speculative stocks like the meme stocks and other gimmicks that are out there right now. One of those gimmicks was this meme stock craze for Dork. Dork stood for, I think, Krispy Kreme, which is ticker symbol DNUT. O was for Open Door, ticker symbol OPEN. The R was for Rocket Companies, RKT, which is actually a stock that I am a long-term holder in. And so I actually don't think it's a gimmick stock. And the K, which is this one, Kohl's Corporation, KSS. You can see why you just can't be chasing these stocks. I mean, Kohl's went up as high as 2154 on a day when it gapped and crapped and still gained 37.6%. It was as low as $6 back in the April lows. And you can see sellers have taken advantage of the meme craze on this one. They have sold this stock down almost every single day since that breakout, except for one day, which of course probably unfortunately tricked a lot of people back into the stock. And now it's almost actually just call it a complete reversal today at the lows. So the irony here is because of what's being set up, this actually almost looks like a calm after the storm setup. So I'm now looking to see, okay, if maybe buyers show any interest in this, maybe, just maybe, I might try to speculate alongside this, but only when the market has, the market internals, the market technicals have improved. So I know I'm talking out of both sides of my neck. Don't chase, but I also can't resist good technical setups like this one looks like it could be. Because notice that the uptrend is still intact from both the 50-day moving average and the 20-day moving average. So that's what makes this attractive, at least for a potential rally back to 200-day moving average resistance. Okay, so enough on that one. I've written about this Bitmine Immersion Technologies, ticker symbol BMNR. I warned about this, and that warning proved correct, even though the stock is just it hasn't collapsed, but it's dribbling down. You could see the mania took this stock all the way up to about 162 at its highs, and now it's all the way down to 31. Let's just call it $32. I said that I might start considering this a buy at 35. I still left it alone and I'm still leaving it alone. It looks like it needs to test 50-day moving average support where buyers need to prove their interest. You can see buyers have largely been absent and the default direction has been down. As a reminder, BMNR is one of these treasury companies. They're going to be doing Ethereum and some other financial engineering magic. Tom Lee caused all the excitement for this company when he got on the board, and he's been, it jumped, what was this, a crazy almost 700% that day. And he has been constantly out there talking the bullish story for this company. So it's very telling to me that Tom Lee's multiple appearances have not been able to revive this stock. And of course, right now, as I speak, crypto is actually going through a second wave of selling. So that's also going to depress enthusiasm for these kinds of stocks. So as much as I warned about this stock earlier, like I said back then, I still want to be keeping this on my radar for a buy because it seems like these treasury companies that are going to be providing stable coin services are the future for the financial system. How much of the future, I don't know. I'm not going to speculate, but at least the market seems to think they're important. And I actually am starting to listen to more and more of the story of the narrative, and it's starting to convince me. Now, the interesting twist is that the company announced a $1 billion buyback authorization. Sorry, they authorized a $1 billion buyback program. Now, that one doesn't make any sense to me, except if you're trying to communicate to the market that you're convinced that the current stock price is just too low. But the reason why it doesn't make sense to me is because all the cash that they have is supposed to be dedicated to buying Ethereum and doing this stable coin, this treasury function. Sorry, I'm getting the Ethereum and stablecoin stuff all kind of twisted up. But anyway, just to make it simple, the choice, I watched a video on this, the choice between buying back stock and buying more Ethereum is an odd one to me because you should just be focused, in my mind, you should just be focused on buying the Ethereum and sticking to the company strategy. Buying the stock just reduces the amount of cash available to buy Ethereum, which is the fuel for the future strategy. Buying back stock doesn't do anything except for return cash to shareholders that shareholders would actually prefer you to put into Ethereum and into the stable coin and into all the other great things that BitMine is supposed to be getting into. So let's see. When they finally announce that some shares have been purchased, maybe we'll get some more clarity as to what in the world their strategy is beyond just a marketing headline to say, hey, we think our stock is trading at too low of a price. Okay, that's enough for BMNR. Along these lines, we had another company that announced treasury operations. They were a Therapeutics Holdings company. Actually, maybe they're still doing Therapeutics as they do their Ethereum treasury operations. I never got a chance to write about this one and warn folks off, but you can see just, this is just such gimmickry. It traded up to about $19. It's all the way back down below $3. It's even below its 50-day moving average again. Who knows when this will stop? But there are just way too many companies trying this trick. And just to give you some perspective on why, I mean, look at this just constant downtrend. And of course, along the way, this company has had, I'm sure, several business pivots. So one point in 2005, 2006, this thing was at 8.7 million. Okay, you wonder how can a stock get up that high? Actually, it's not how could it get up that high. It's how many reverse stock splits have they done. So this huge gain here is just kind of it's a relative illusion. And it's the exact kind of thing that I would warn not to chase. I'm not interested in buying this at any price, but to me, I like to keep an eye on it because it just is a good indicator of the speculative fury that's in the market. And once I saw, of course, the selling from this point just go underway, I knew that the gas was draining or leaking out of the whole meme stock speculative frenzy. Okay, so let's go to a more legitimate treasury company. This is a stablecoin company, sorry, Circle Internet Group, ticker symbol CRCL. I think I mentioned before how I really regretted not just jumping right in I was listening to too many folks that thought that this was too high. I certainly wasn't going to chase, but now you can see the stock is starting to come back in. It's now at a new low, sorry, a new low. Let's just call this a 1.5 month low. So it's actually in bearish position. It's below its 20-day moving average. The 50-day moving average will probably open up soon above this line. So that when that line finally shows up, this stock could be in a bearish position already. So this is not a place where I would risk any buying, but I'm looking to see whether this gap gets closed here, and this would be at a 134. And then, of course, there's another gap that needs to be closed, that could be closed at some point at 83. So those are the points to watch just for on trading purposes. But I think this is one of the more legit stable coin type plays for a longer term. It's just hard to jump in when the speculative fury is so high. All right, I know this is a long one, but I like to record these videos also for my own purposes and own archives, and also just to talk through my own reasoning, and to set up my own thinking for coming up trades. If you actually manage to make it through this long, I would love for you to just put a comment down. You might be one of two, three, four, five people who made it this long, but I appreciate you hanging in there. Don't forget to subscribe to the channel so you get more content like this. If you have any comments or feedback, put it down below. And as always, like and share this comment this content so that the algorithm knows what's up. So again, I'm Dr. Duru from Ahan Analytics with the market breadth. I will see you later. Check out the blog, drduru.com/122, all letters. Take it easy.